My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate how to account for the issuance of shares of stock. And we are going to use the recent IPO of Twitter to demonstrate what has happened here. So I've already gotten to the Twitter website and just want to talk about a few things, and then we'll demonstrate how Twitter is accounting for this recent IPO. So one of the documents that Twitter has to file, or any company that is going public has to file, is something called an S1, which is a SEC disclosure statement. And one of the components, or one of the parts of the form, is to describe the capital stock. And so this S1 shows Twitter's description of capital stock, and we can see here that they have 5 billion shares of common stock for which they are authorized to issue, and they have 200 million shares of preferred stock of which they are authorized to issue. And each of these shares of stock have a par value of $0.000005 per share. So the par value is a fraction of a share, a fraction of a dollar per share. And that kind of heads home the idea that par value is becoming less and less relevant. Nevertheless, the accounting rules still make use of par value, so we have to deal with that. Also of interest here is that some of these common shares of stock are already outstanding. This is before the issuance, before the recent IPO. This is as of September 30th, and if you remember, Twitter didn't go public, quote unquote. They didn't have their IPO until November 7th. But there are about 475 million shares of common stock already outstanding, being held by 755 stockholders. Now, that's a very closely held organization. Obviously, those 755 stockholders of record are probably board of directors, the original creators of Twitter, a handful of institutional investors, and that sort of thing. But that's where they were as of September 30th, 2013, prior to the IPO. Okay, so now let's talk about this IPO and how Twitter is going to account for it. By and large, in today's environment, accounting for the issuance of common stock or capital stock, common stock or preferred stock, is actually pretty simple. So in my notes here, how do we account for contributed capital? We simply identify the fair value of assets received at the time of issuance. Now, in some cases, we're not receiving cash when we issue capital stock. A company is not mandatory to collect cash. They will collect whatever assets investors are willing to give them, especially small companies or closely held companies that might not be going public. Investors may contribute assets of other sorts, like cars, buildings, transfer the ownership of some specific fixed assets to the ownership of the company. And we just need to identify the fair value of those assets. When we're talking about publicly traded companies, we're dealing in cash. All right, and so we have to account for the fair value, obviously, of the cash that's being received. And then we have to account for the par value and the additional paid-in capital separately from one another. All right, so let's see how this would work out for Twitter. All right, so Twitter's IPO on November 7th, 2013. We've already talked about the fact that Twitter is authorized to issue 5 billion shares of common stock with a par value of that fractions of a dollar per share. They're also authorized to issue 200 million shares of preferred stock. Right now, they have, or prior to this IPO, they had about 475 million shares held by the 755 shareholders. What happened on November 7th is actually just simply the issuance of an additional 80.5 million shares at an IPO price of $26 per share. Now, the difference between the 475 million shares that's already held and the 80.5 million shares that were issued on November 7th is the nature of the issuance. The 80.5 million was issued through the Securities Exchange Commission and the New York Stock Exchange. The 475 million shares that are already held were not issued in a public forum. There were only certain individuals and certain institutions that were even permitted to buy those initial shares. So the IPO for Twitter is just dealing with the 80.5 million shares that were issued on November 7th at an original issue price of $26 per share. So what will happen then in terms of a journal entry is that Twitter will debit cash for approximately $2 billion, just over $2 billion. They'll have to deduct some expenses and registration fees and that sort of thing, but they'll end up raising just about $2 billion of cash. Notice that the common stock account gets credited for $403. And this again kind of emphasizes the point that par value is relatively minuscule and is irrelevant actually at this point. We take 80.5 million shares and multiply it by the 0.000005 dollars per share. That works out to $403. For a multi-billion-dollar company like Twitter, $403 gets lost in rounding. And I've commented in class several times that for disclosure purposes, a lot of companies now are just simply combining the capital stock account with the additional paid-in capital because the capital stock account is so small in comparison. It's just not relevant information. But in any case, technically what has to happen is the capital stock or the common stock account gets credited for $403, and then additional paid-in capital on the common stock gets credited for the remaining portion. In this case, $2,092,999,597. And so that is all there is to issuing capital stock. Cash, or the fair value of assets, gets debited. The common stock account gets credited for the par value of the shares that are being issued, and then additional paid-in capital in excess of par gets credited for the remaining portion. Now again, this just once more sort of emphasizes the point that par value is becoming less and less relevant from a practical standpoint. Eventually, the concept of par value will disappear completely, but that's where we are right now. So that's an example of issuing common stock.